dear students. Today we are discussed to related to the finance. Okay, the introduction related to the finance. Okay, what do you mean by finance? Finance is one of the lifeblood of the business. There is no finance. Finance means what is that? Money. Money is one of the lifeblood of the business, and each and every individual, there is no finance means there is no moving of life. There is ups and downs, each and every activity. The finance is a main role. Lot of examples is there in this finance. In family businessman or individual income of one of the people, you are earn money at a month of 10,000 means how to allocate your fund. Okay, that is the management. The allocation of fund is a proper manner. That is the management. So the finance, how to handle the finance, that is very important for in this financial management. So you are studying in this financial management, that is based on the introduction part, that is concentrate with that planning, directing, monitoring, organizing and control the monetary resources. Okay, what do you mean by monetary resources? That is worthy of value of the assets. Okay, so the assets, they are divided into fixed and current assets. Each and every aspects point of view, that is the finance allocation is very important for furniture and such kind of the machinery. These are the things that is example of fixed assets. And current assets means that is easily convertible into cash. So you are investing in a business, that is money, how to allocate. That is based on the fixed assets and current assets. And also it is simply that is means the allocation of fund in a proper manner. That is the financial management. So here the Ray G. Jones Dean, that is the in this finance, that is the Latin word, it is called finish. Okay, finance function may be defined as the procurement of funds, that is the procuring, that is the proper manner, the procuring the fund to the finance. So these are the finance concentrate. It is another one thing. The concept is business finance. In this Gautam and Dogol, business finance may be broadly defined as the activity concerned with the planning, raising and controlling administering. That is nothing, that is allocation of fund. What basis you are plan for investment of money, how to raise the finance. It is on how to raise the finance, that is based on your investment. You are investing such kind of the fixed assets, that is land, or you are purchasing the land or otherwise fixed deposits, and also you are investing such kind of valuable machineries or vehicles. These are the things they are needed to the business. That is the how to raise your finance. You are investing the shares, you are investing such kind of bonds and securities, buying that such kind of machinery. So you are plan the return of your finance, the return back of interest of the money, that is valuable one, the worthy basis you are invest for the money. These are the concept in comes under business finance. Then what do you mean by financial management? Here in this financial management, the deals with the study of procuring funds. Already discussed in this procuring funds, how to procure your funds. That is safe investments, how to save off your money. That is very important. Here the utilization of money is also very important concept of this. Here the overall in this financial management objectives and expectations and based on your raising of funds is very important concept of in this financial management. And here discuss there are concentrate with the three activities. That is first one is anticipating financial needs. What is that anticipating? That is the predicting of a financial, what are the needs of the finance. That is very important. It means the estimating requirement of the firm. What is that? Estimate the long term finance and short term finance. What is the need of the finance? That is very, very important. Here, the investment of fixed assets and current assets. How to, what is your need for your business? The fixed asset, how much amount spend that fixed asset, that is the current asset. You are anticipating, you are predicting for a future base, you are investing the money. And also acquiring financial resources, acquire, that is the purchasing from this different sources they meet for their financial needs. Okay, what are the raw materials or such kind of investment acquire, that is very, very important for an three activities of a financial management. And also allocation of fund. Allocation of fund is, that is based on the your allocation, investing initial investment of share capital based on how much spend for wages, such kind of the expenses or small expenses, and also such kind of the investment. These are the concept base you are invest the money. Here, there are three definition mentioned here. That is, first one is financial Solomon definition. This based concerned with the efficient use of an important economic resources, namely capital funds. What do you mean by that is the capital funds? That is the initial investment of funds. Okay, such kind of securities, such kind of bonds. These are the things based you are investing your money to the business. Then financial management, the second, the James C. Van Horn, that is defined, that is acquiring financial financing and management of assets with some overall goals of mind. These are the second definition. And also the procurement of effective utilization of business. These are the third definitions comes under the financial management. Then nature of financial function. Here there are three nature of finance functions mentioned here. KM Udayai, it is most of the organizations financial operations are centralized. Here the nature means, that is the characteristics of a financial function. Most of the organization, the financial operation is one of the centralized. Centralized means it is the main important concept. Without finance, there is no operation of a business. There is no moving of a selling or buying. Without money, there is no operation of each and every organization. The second one is finance functions are performed in all business firms irrespective of their sizes. Okay, all the business firm irrespective of their sizes. Here, the legal forms of organization based of the finance function only based on your irrespective of their sizes. That is large scale or small business or large business and medium level of business. It is based on the well performed of the business firm. It is based on the finance. Okay, the contribute of the survival and growth is, it is one of the financial functions. And here remaining another 4 points explained here. Finance function is primarily involved with the data analysis and decision making. All the decision making purpose, the finance function is one of the important role. And also finance functions are concerned with the basic business activities of the firm. It is all the business activities of the firm means all the external related activities. The finance function is the main role of the role. It is based on the external, that is the business operations and loans and funds raising. These are the concept based, and the finance function is concentrate. And here finance functions comprise the control all the functions. Remaining, what are the all related functions? That is the marketing functions or such kind of the selling and distributing functions. All the functions that is based on the control by the finance. The central focus of the finance function is one of the value of the firm. And another one important concept of finance functions, that is the scope of financial management. Here in this scope of financial management, that is they are divided into two. That is the traditional approach and also the modern approach. What do you mean by traditional? It is olden form of the approach and modern is latest. Okay. Olden form of the approach is the way of finance. Okay. Here the traditional approach first one is institutional sources of finance, and second one is issue of financial devices to collect refund from the capital market, and the third one is accounting and legal relationship between the sources of finance and business. Okay, here the institutional sources of finance. Here in this olden days, the traditional approach only based on the institutional sources only they are followed. Here the second one is the financial devices collect and refund and the capital market. These are the important concept of this traditional approach they are followed. And the third one is accounting and legal relationship only they are followed in this traditional approaches. And in this traditional approach, such kind of the limitation is there. That is one of the one-sided approach. Only the business activities they are followed in this concept. So that is one-sided approach. And the importance of the problems of corporation, all the importance only the inside of the corporation's activities they are followed, and also attention to irregular events. Here, the irregular events, um, uh, only the inside of the financial activities they are concentrate. So the irregular events, they concentrate the deep in manner for a inside of the organization. So and more emphasis of long-term funds. It is help to the more emphasis on the long-term funds. It is concentrate only long-term funds. So the short-term funds concentrate declines level means that is one of the limitations of the traditional approach. And in this modern approach, there are three critical taken this approach: investment decisions and financing decision and dividend decisions. Uh, Investment decisions, and they discuss related to the investment decision, how to invest the money right way of your business, that is investment. Financing decision means that is allocation of financing, and dividend decisions means the return back of the money based on the high rate of interest base, they are dividend decision, taking a dividend decisions. um, then features of modern approach. There are four features: more emphasis of financial decisions, continuous functions, and the broader view and the measure of performance. In this modern approach, such kind of the advantages is there. It is taking a financial decision based on this. They are using for a financial manager, such kind of the advantages based. What are the return? How much return more benefit to a company and individuals, that basis in this financial decision help to the customers or help to the employees, all the manner they are discussing. In this continuous function, it is one of the modern level they are using for this financing functions, and measures of performance is also taken. Then objectives of financial management. There are two objectives in this financial management. The major objectives is first one is profit maximization, and also the second one is wealth maximization. What do you mean by profit maximization? Maximum profit is always increased to our business. In this profit maximization, the rate of interest, dividend, and such kind of interest they are written, the high percentage level they are encouraged, and wealth maximization is that is the wealth of the company, that is also one of the maximization of finance, that is help to the organizations. And in this profit maximization, one by one discuss, the firm should undertake those actions that profits for our one of the encourage for our profit maximization, would decrease those action that would decrease profit, that is identified in this profit maximization. Then the financial decision should be oriented to the maximization profit. It is nothing, all the related how, what proper way they are using in this profit maximization. How to raise your profit? That is very important concept of in this profit maximization. Profit is one of the yardstick of the each and every company. Profit is one of the yardstick of the company, and it is ensure the maximum social welfare. It makes allocation of resources and profitable desired areas. Which area that is prefer for your profit maximization? That is also one of the important concept of profit maximization. And wealth maximization. Here, wealth maximization is net present value maximization provides an appropriate operationally feasible decisions in this financial management decisions. This is the one of the wealth maximization uh, for a business. The current wealth of the firm that is used to the following the formula, that is share owned by that company and also current stock price shares. Finance function. In this finance functions, they are list out some of the 4 points here: assessing the financial requirements and assessing, that is the measuring the financial requirements, and also the second one is proper utilization of fund. The management concept is easily says that maximum utilization of resources. Okay, allocation of resources, maximum utilization. Here the utilization of fund, the maximum utilization of fund, that is the high return basis, the utilization of fund, that is one of the concepts of finance. And also increasing the profitability, that is how much returns after investing the money. That percentage is very important for increasing profitability. And here also the maximizing value of the firm. The value of the firm, how to calculate the value of the firm? That is the calculate based on the returns, the worth of the company, amount the investing, how much the return back, all the value of the firm, that is calculated. Again, another one topic is discussed, that is the finance functions. Here, the planning and the control of finance functions, increasing profitability. Always increase the profitability. One of the main concept of finance functions. Here, there are investment financing decisions. All three decision is there. First one is investment decisions. In this, investment decision is related to the selection of assets. Invest, how to invest, where to invest, when to invest. That is very important. How to invest, that is the maximum returns. Nowadays, the gold is, the rate is very high, right? Today, that is the one of the return, the percentage is very high. In olden days, there is low investment, only they are invest to the gold. Okay, here a lot of returns, the increasing the growth rate of the gold is very comparatively very high. So you are selecting for assets, you are selecting for a investment, that is the very important to the investment decisions. The second one is the assets that can be acquired by a firm may be long-term assets and short-term assets. Such kind of examples given to the long-term assets and short-term assets. Here, what do you mean by long-term assets? The long-term assets, such kind of the fixed, so it is example of the one of the fixed assets. Okay, fixed assets, it is like furniture, land, building, purchase of the building, and that is the based on this assets you are investing, how much amount invest to the shareholders, or how much amount invest by the shares, and how much amount invest by the fixed assets building. These are the concepts comes under the examples of fixed assets. And the current asset, it is one of the easy convertible into cash. Okay, here such kind of short term base your amount invest by the company. Here decisions with regard to the long term asset is called capital budgeting. Based on this your decisions, you are budgeting for the investment of the capitals also. um, Here another one short term of current asset is called working capital management. What do you mean by working capital? Working capital is current asset minus current liability. How to invest? The ratio is 2:1. Here the current asset is comparatively less than that is the less than the current liability. Okay. Capital budgeting. Here, the capital budgeting is related to the selection of assets and investment proposal, which is yield benefit to the future. Capital budgeting, how to budget the capital, your initial investment of the capital. It is one of the proposal evaluation of the investment proposal terms of risk association base you are invest to the amount. Then working capital management, and already explained what do you mean by working capital. That is the current asset minus current liability. It is proper allocation of fund. It is working capital. That is very very important concept of the working capital. It is denoted, one is one of the, it is between the profitability liquidity position of a company. Then working capital management, again 2, 3, 4 points is explained here. Working capital already explained. Working capital means that is the current assets minus current liability. How to manage? That is the manage. Manage means that is the allocate properly. It is the ratio base you are meet for the current assets and current liability. Then management of working capital. The management of working capital based on the two aspects. First one is overview of working capital management and also the efficient management of individual and such as that is the cash and receivable managements. Okay, all the receivable investment inventory receivables, stock receivables, and these are the things. Okay, it is concentrate on the working capital management. Then second point is there are 3 point financing, investment decision, financing decisions, and the second one is financing decisions. In this financial decisions based on the mix or capital structure, the structure of the capital. Okay, that is the financing decision. The structure of the capital structure, what do you mean by debt and equity? It is based on the capital structure is the debt equity ratio is called the capital structure. The debt, here your equity share capital or debt. The debt means it is one of the debt by some other collecting of the loans or such kind. It is determination of the proportion of equity and debt is main issue of financing decisions. In this once best the combination of debt equity is next step, how to raise for the appropriate manner, what are the source base you are financing, that is very very important. Proper allocation of debt and equity is called that financing decision. Okay, debt and equity is called financial. Equity means equity manner you are investing for a finance to the business. Debt is other sources, such kind of loans, such kind of issuing of shares. These are the ways you are run for our business. Dividend issues, already known. What do you mean by dividend? That is, dividend is one of the you are you are buying of the shares. After that, they are dividend. Dividend is interest. Some of the organization they are given to, that is the interest amount, that is called dividend. Shares, bonds, you are getting the invest the shares or you are buying the bond, that is you are getting back the dividend, that is the interest. Then a firm distribute all profit retained, then distribute the portion of retained balance with it. Which course should be allowed? The decision depends upon the preferred shareholders' investment opportunities. Who is called preferred shareholders? The based on the shares preference base, you are investing the shares by the company. Then dividend decisions. Dividend decision has, it is one of the one of the strong influence of the market price and such. And so the dividend policy, it is determine the impact of the shareholders. Here the dividend policy, it is one of the value of the firm and value of the wealth of the shareholders. Then role of a financial manager. There are three roles comes under the financial manager. That is the investment decision, financing decisions, and dividend decisions. It comes under the investment decision, how to invest the money. Finance means how to allocate the fund. Dividends means how to return back for a dividend. These are the concept is financing. And next on is the organization of finance functions. It is based on the finance function, the divisions functions relating to the finance. It is one of the major financial policy of the financial functions. It is there is the different levels. They are financial manager, they are followed, comes under the finance functions. Here the organization finance structure is mentioned here. That is first on is board of directors, comes under the board of directors. That is managing directors. In this managing directors, there are different department is there: production department, purchase department, and finance, and personal and marketing departments. So all the director comes under the managing directors. There are five different departments. Based on the departments, their role is the production director, purchase director, finance director, personal director, and marketing directors. Here in this finance directors function is comes under the finance director functions. Allocation of, again, that is split on this all the functions. Then sources of finance. Here the sources of finance, capital required for all business can be classified under two main categories. That is first one is fixed capital and working capital. Sources of finance, long-term funds required to the create production facilities. That is plant, machinery, land, building, furniture. These are the long-term sources of finance. In this investment decisions represents the firm capital which is permanent or fixed basis, that is called fixed capital. And short term purchase of raw materials, payment of wages, other day to day expenses, it is comes under the short term capitals. Here, lot of explanation here. The sources of finance. Finance is indispensable today, is rightly said, to the lifeblood of the enterprise. Already one by one discussed in this beginning itself. So these are the point. There are two methods of raising: owned capital and borrowed capital. Owned capital is within your hand, cash in hand. You are investing your own money. That is the owned capital. Borrowed capital, such kind of loans and such kind of debt, such kind of other related issuing of issue of banks. Other related funding agencies, they are invest such kind of money. That is the borrowed capital. Sources of finance. There are three sources of finance: allocate short term, medium term, and long term. Short term means that is bank credit and advances, trade credits. Medium means issue of debentures and bank loans and public deposits and loan from financial institutions. And long term, issue of shares, issue of debentures. It is the categorization of sources of finance. Issue of shares. Already all are aware related to the issue of shares. The company owned capital based on the split into the shares. It is called a share. Okay. That is in each and every shares, thousand into 100. You need money for 10,000 means that is the 10 per share, 10 into 1,000. The based on this ratio, for example, 1 lakh means 100 rupees per share into 1,000. These are the concept you are issuing of shares. Okay. Here, the person holding the shares to the shareholders, it is one of the part of the owner of the company. Who is issue the shares? The owner of the company. The owned capital, it is based on the issue of shares. The purpose is owned capital. Issue of shares. The capital is company ideal, that is the long-term requirement basis they are issuing to the shares. There are two types of shares, that is equity shares and preference shares. Already explained in this previous 2 3 slides before, explained clearly. Equity shares means equal ratio, equity, equal manner you are distributing shares to the public. That is the preference shares means one who prefer the share, who is willing to buy that particular company shares, that is the preference shares. There is lot of difference between equity shares and preference shares. In this equity shares, the equity after the profit is after distributing to the preference shares shareholders, that is the dividend ratio, it is 8% only the preference shares. And in this equity shares, after getting how much amount of profit in this company, then they are distributing the that percentage only, distributing the equity shareholders. Then here explain the equity shares, the number of special features is there. The dividend on the shares are paid after the dividend to the already here also explain. The dividend on these shares are paid after the dividend preference share has been paid. Here the rate of dividend depends upon the amount of profit based on this intentions of the directors. Then equity shares have the chance of earning good dividend, prosperity, and run the risk of earning nothing in times of adversity. Here, the equity shareholders residual claim the assets of this, only the liquidation of this, in this case of liquidations. Here, the company is controlled by the equity shareholders entitled to the winding up of the company when distributing all the equity profit, or when the company is winding up, that time only the correct profit ratio is distributing. Then preference shares are those which carry preference right over the shares with regards the payment dividends. Preference shares is a fixed rate only distributing the shares. But equity share is not fixed. How much amount is profit, that is divided into equal in this equity shareholders. Okay. Any doubt, please ask me. And here conclude in this first unit. In this first unit, we discuss these are the things. What is finance? What is the meaning of finance? And also financial manager role, and finance the function, and decisions, investment decisions, financing decisions, and also working capital. Such a brief introduction related to the working capital, and what do you mean by the preferences, and also what do you mean by equity shares. These are the things discussed. And the following any doubt, please ask the following classes. Okay, thank you.